Thank you, Zareen. Good morning, good afternoon, and welcome to this month's edition, this October edition of our virtual home buying seminar. And we are absolutely thrilled with our today's topic around interest rates. Very timely, a lot of news on what's going on with interest rates, so we'll be sure to dig in on that. But before I get started, I wanted to welcome you to today's call. My name is Dan Sugg. I am the Chief Mortgage Lending Officer for Michigan First Mortgage, a division of Michigan First Credit Union. My office is here at Evergreen. If you're here in the lobby, if you're one of our members and you're getting a coffee out at the coffee cafe, I'm right behind it. So hopefully we get a chance to meet someday and hear your story. So again, without further ado, let's get started. I'd like to go through today's agenda briefly. We will start with introductions, which I'll do here in a second, talk about what factors into an interest rate, then finish with tips and tricks and really the things we think our experts think you should take away from today's call. But we will spend the bulk of our time really talking about factors that go into interest rates and how we determine those and how they affect the home buying process. So I would like to welcome to the call Tyler Seaman. Tyler is a loan officer for us in Rochester, certainly covers the entire state of Michigan. But Tyler, you've been with us a bit now, so tell us about your background and what you bring to our members and the home buying process.
Yeah, thanks, Dan. And hello to everyone on the call. Thank you for joining us today. And wherever you are, we appreciate you being here. So yeah, a little bit about myself. So I've been at Michigan First for just under a year now. I'm coming up on that 1-year anniversary, and it's been an absolute pleasure to work with Michigan First, and really looking forward to getting into today's topic of interest rates. Very interesting topic. I'm sure everyone has a lot of questions about that. But a little bit about myself. So I've been in, I would say, general finance for pretty much since I left school. So went through various cycles of different types of financing, whether that be banking, investments, lending, and mortgage too. So have a little bit of knowledge on pretty much everything out there. So yeah, just really looking forward to that, and being able to help you make wise decisions when it comes to purchasing a house.
Yeah, and Tyler, with your background, you're tackling a pretty in-depth topic today. So I know you'll make it very user-friendly for us to hear about what goes into a mortgage interest rate and how that affects us. So our other guest today is realtor. If you want to pull that up, Zareen, real quick. There you go. Jake Roberus is joining us, and Jake is a realtor, and he absolutely is here to help us understand how an interest rate plays into that home buying process. Certainly, as you're looking for a home or maybe qualifying for a home loan, what that is from a realtor perspective. So, Jake, tell us a little bit about yourself and how you can serve our members.
Hi, Dan. Thank you. And hello to everyone out there. Excuse me, my voice was cracking. But yes, I'm a realtor. I've been in the industry for about 5 years now. I work with realty and real estate. And I actually started in the commercial industry and drifted my way over to residential. And yes, I work throughout both industries. And my main focus is helping, first-time home buyers, people trying to sell their homes, and just, anybody that needs advice in general in the market. So that's a little bit of what I do. I know that's vague, but there's a lot of moving parts as far as real estate goes.
And it sounds like you, reading your bio there, you followed in your father's footsteps. Was your dad a realtor?
Yes, he is. So he's been a commercial broker for over 30 years. And, small pieces. That's really how I got into it. I didn't really know much what I wanted to do when I was younger. And I realized that, I just always followed him around and worked with him at a young age. So that's what got me into this. And I had more experience than I thought just following him at a young age. So that's what really helped me get started and showed me what my passion was.
Great. Thanks for joining us today, Jake. So let's jump into the conversation today. So, boy, we hear this a lot. We hear, talk, especially recently and this year, we hear about what's going on with interest rates and what's driving them. And even somebody like myself that's been in the industry for 30 years, it's still still learning about it every day and the impact of interest rates on the ability to buy a home. So I guess I'll start with Tyler, and we'll start that very broad question. What is an interest rate? Like how does that work?
Yeah, that's a great question. So there's a really simple answer to what an interest rate is. So by definition, an interest rate is strictly the cost of borrowing the principal amount of the loan. Okay, so again, it is the cost of borrowing the loan, right? So we can kind of leave it at that. There's there's some differences, but obviously that's not the only cost that goes into a mortgage. It is the primary cost, but that doesn't include fees or costs by the lender or title or insurance, things like that, that go into the total mortgage piece, but it is a big piece.
Yeah, and certainly when financial institutions like ourselves or even independent mortgage companies calculate that rate, what other things go into that are risk, or the maybe somebody not paying the mortgage back that you have to cost that they can't foresee. So certainly there's a lot that goes into an interest rate other than just, boy, that you're borrowing 100,000, you're going to pay me 4% back on that over time. So certainly a lot of other things. So Jake, if we're thinking about home ownership and real estate, I guess, how does interest rates affect buyers overall in the real estate market when you think of that? So, let's say rates change. What effect does that have on the market for you when you're looking for a home for someone?
And that's a great question, because that's one of the most important things to consider when you are looking at a home. Now, rates, just like Tyler had said, affect your overall cost and honestly affect overall what you can afford. So at a higher rate, you might be able to afford less of a house due to the pricing in the market. And that all correlates with the type of market that you're in, whether it's a seller's market, for example, or a buyer's market. So it's important to know where your rates are and the type of market that you're in, because that's really what dictates what you can afford and what's going to make sense overall for you as a buyer. Because I think everyone agrees that the most important thing is, what is it going to cost at the end of the day?
Right. Yeah. And going back to Tyler a little bit, Tyler, if you think about interest rate, it's important, certainly, but what's more important than interest rate is the payment, understanding, what that monthly note is going to be on that. And is, what value, Tyler, do you see in starting with the payment versus the interest rate for one of our members?
Well, like you said, ultimately at the end of the day, it's can I afford this home? No one does their budgets or their spreadsheets based on, well, what's my interest rate on everything? No, you do it based on what your monthly payment is, right? So it really comes down to, can I afford this home? If we do, let's say just your average 30-year fixed, and you're comfortable with the payment, and it can fit within your budget each month, right? And you love the house, you gotta love the house.
Yeah.
I would say that's the most important part. There's always time in the future that you can eventually go save yourself a couple of maybe a couple $100 each month on your payments, if the market allows it. Yeah, and I'll get a little bit more into down the road in what that all entails. But yeah, to answer your question, it's the payment.
So, we heard a lot about interest rates this year, and I certainly can provide some detail on where we're at with that, but I wouldn't get too lost in what the rate is today. To your point, I've been in this business almost 30 years, and we've had 8 instances where the rates have peaked and then dropped to a point where people could save money. So, given what's going on in our financial situation and economy today, certainly we're seeing some indicators that rates will be going back down at some point here, maybe in the next year or 2 or 3. You don't want to hinge your affording the home based on a lower rate, but certainly watching that payment and understanding you can afford that today is just as important. So Tyler, if we segue a little bit, so what's the difference between interest rate and APR? I see that a lot in advertisements. Like they'll say the rate is X and then the APR is a little bit more than X. So what goes into that calculation? And how do I know what the difference of those are when I see advertisements?
Yeah, so and I think APR, annual percentage rate, that's how we like to say it, is it doesn't get a lot of love. No one really knows what the heck that number is and why it's super important to you. At the end of the day, annual percentage rate is more important than your interest rate. I will, if you can take one thing away from that, it is more important. It's more on point with what you're actually going to pay. So, if I can give you a simple definition of what the differences are between them, is an annual percentage rate is considered the better overall picture of what you're going to be paying for the loan. Okay, so this includes the borrowing of the principal. So it does include the interest rate in there, but it also includes the fees and costs that go on with the loan as well. So your closing costs, things like that, the interest rate does not entail. So, when you see all of these advertisements, you might see, okay, 6.5% interest rate with a 7.4 APR, right? You need to be paying attention to that 7.4 APR because that's what you're actually paying for. So, yeah, if that answers your question, Dan.
So certainly APR was invented for the consumer. It was to fairly represent the total cost to get that interest rate, to get that home at that point in time. So there are some other things that go into that. I would ask, when mortgage companies advertise, they have to represent an APR, and it is on there. So what would be the difference though? Like, why would your APR be lower than not? And am I just prepaying more interest up front? Am I paying points? What's the difference in that?
Yeah, so it can come down to paying points. It can come down to the origination fee, which in simpler manner, a lender fee. What is the lender charging you to write that loan? That goes into that APR. And usually the bigger spread you see is really the amount of money that lender is charging you to write that loan. So I do see
she's asking what are points. So
yeah.
So that was going to be my follow-up. So points is a way for a consumer to prepay interest on a loan, and a point is a percentage point of the loan. So round numbers, 1 point on $100,000 loan would be $1,000. And that essentially you're prepaying the interest. So you would reduce your overall interest rate upfront. So Tyler, does that make sense for every member, or in some cases to prepay those points?
In some cases it does, in some cases it doesn't. So everyone has a different goal. It's not a cookie cutter thing that you can just say, hey, yeah, everyone should pay as many points as they can, right? That's just not life. And some people have maybe a larger down payment that, okay, well, it makes more sense. Maybe I can put some money towards the cost of the loan and pay a couple points to get my interest rate down. Maybe someone that doesn't have a whole lot of down payment, maybe we do have some room within there, and maybe even give them a little bit of a rebate, right? So that's kind of the opposite of points. It's like, we're giving you a little bit of help in the front end to lessen that upfront burden of your down payment and things like that. So it can work both ways. And if anyone has any other questions about that, what I like to do personally with all of my borrowers is I like to show them. I like to really let them have a visual of what does that mean and how does it work, and what, according to your specific loan or goal of that home, we get to walk through that together. So it's not just me, coming up with numbers and saying, hey, this is what you should do.
Yeah, certainly on every loan, there's a break-even point on whether it makes sense to pay down points, or in Tyler's example, take a higher rate and get some money back to help pay for some costs or some of those things as we go. And Jake, we're talking a lot about points today, but as it comes to real estate, how do interest rate affect the buyer's overall I think I already touched on that. So why is it important to frequently check rates during the home buying process? Like what could happen during that 30 or 45 or 50 days to find a home in that process? Why would they need to frequently check?
Well, that's a really good question, especially right now, as we're starting to see a small shift in the marketplace where rates were, at all-time lows to now where they're rising. They're rising. So at the end of the day, it's really going to affect, where your payment is, what the overall cost is. And in my experience and what I do is that's how we want to tailor your search, because we want to find the perfect house, but financially it has to make sense at the same time. So whether rates go up or down, it's important to check on them, because if they go down, you might be able to afford more of a house now. You can afford something maybe you didn't think you could before, but as rates go up and your payment goes up with that, it all correlates. It's going to depend where the prices are as far as the marketplace goes, because that can really dictate what you're able to afford in the current marketplace. It's ever changing. Nobody has a crystal ball per se to see what's going to happen. And that's why I always preach that it's important to know where those rates are, because you never know how your costs could change. One house you liked last week that you could afford, if the rates go up, you might not be able to afford it, and it might not be realistic this week. It's ever changing, and that's why it's so important to have a healthy level of communication between your agent, your loan officer, just to know where you're at, because that will dictate how soon you can get to your end goal and get into the house that you want, because there's so many moving parts, if that makes sense.
Yeah. And if you're working, in conjunction with two realtor and loan officer, you can run some scenarios, right? When you're at time of pre-approval and the rates are 6%, you could say, well, at 7, I could do this, or at 8, I could do this, or even at 5. And understand that just because rates rise doesn't mean that you're out of the housing market. You have to reset your expectations, or generally speaking, that flips the real estate market and becomes more of a buyer's market where you have some leverage, maybe. Is that correct?
That is correct. And that's actually something that I'm starting to see. We were in such a strong seller's market, and that purely means that people were able to capitalize on their homes. They were able to sell their homes at outstanding prices, where they were getting, multiple offers, and in some cases, 5 hours on the market. However, as rates start to rise, that changes what people are able to do. So I'm starting to see now that there's more opportunity. Yeah, so your rate is higher than maybe it would have been, 6 months ago, even shorter in some cases. But as that happens, it starts to correlate with the marketplace as things start to shift. So even though your rate rises, your opportunity starts to increase. And there's opportunity in every market. It just depends on what your situation is. But your opportunity starts to increase a little more as you're able to get into homes less competitively. Say, one house had 10 people put in offers, but now that same house may only have 2 people put an offer.
Yeah.
So it affects.
Yeah, I just actually saw some recent numbers, end of September numbers from Freddie Mac around active existing home listings. 40% of active existing home listings had showed price drops or price cuts in that recent measurement, which tells me that people are starting to feel the pinch of a house being on it. There was a time, certainly earlier this year, when if a house sat on the market more than a week, there was a problem. Now, if it lasts 3-4 weeks, people start panicking a little bit. Really the average marketing time for home should be 45-50 days. It really should be in a more healthy market. And I think that's hopefully where we're headed. So if we switch back to Tyler real quick. So Tyler, is the interest rate that I get on my mortgage, is that the most important piece of the mortgage? Like, should I really be hyped up over interest and be really anxious about that?
And I don't want to continue to repeat myself, but no, it isn't the most important part. Is it an important piece? Yes. An interest can have an impact on how much you can afford to borrow, just like Jake mentioned. But it's not the only variable that really impacts you. There are really important variables other than interest rate that that can really weigh in on your affordability. And down payment, right? That's a big one. Down payment has a lot to say about what your mortgage payment's going to be, right? There's a big difference between putting 3% down versus 40% down, right? You're going to have a much different looking payment. Home prices, right? So as Jake was mentioning, you see all these houses being outbid on, and now within today's market, you're not really seeing that in most markets. There are some really hot markets still in certain areas, but we are seeing that transition. So, and then your credit score, right? That's one that a lot of people want to know about, right? You can hold a pride about having a good credit score, and that does have you are rewarded when you have good credit, right? And then obviously we look at three major important pieces: your debts, your assets, and your income, right? So those all have a very large importance in your pre-approval process, in your buying ability. So yes, as I stated, there are multiple things that do impact, not just interest rate.
Yeah, you know what I've seen, and I think this will have certainly impact on both of your statements today, but I've seen taxes be even a larger expense than what people realize because of the increased value. So if I'm buying a home today for $300,000, and the last time it sold was for $150,000 10 years ago, I'm going to be shocked by what those taxes are going to be. If they're currently $2,400, they may be $4,200. And then all of a sudden, I can't afford this house anymore because a year from now, the taxes are going to really increase. So have you seen that, Tyler or Jake, in your business, like real honest hardship around tax increases? Either one?
I can go, Jake.
I didn't want to.
I'm sure he's seen some too. But yeah, if there's a house that hasn't been sold for a long time, at the point of sale, after that thing closes, when taxes are due, they adjust things, right? Now that house has the city or county's attention, and they reevaluate that. So same thing with pulling permits too. I don't want to get too far on a rabbit hole, but if you're making improvements on your house that needs city permits, right? Those things all really can affect your taxes and how much you're paying each year on those.
Yeah, certainly.
That's why.
Go ahead, Jake.
Sorry. No, that's why I was going to say, that's why it's so good to have a healthy level of communication between, your agent, you, and your loan officer, because you can check all that stuff out, but at the end of the day, you got to check what those costs are, because you don't want anything sneaking up on you in the dark as times change. And that's
Jake,
where the market.
Right. We got a couple minutes left. And I want to get to this piece too, because this was interesting for me. So what are the main topics I need to discuss with you as it relates to my rate and home share? I know you touched on a little bit of this, but if rates continue to change, what is important to you in the topics that I should be discussing as a home buyer?
One, you just talked about it, taxes. We need to check that stuff. We need to be doing our homework ahead of time. It's something that I preach myself as an agent. We need to dig deep on every house, communicate with the loan officer, and let's check those costs every single time before we go see the house, just so we know where we're at. Two, frequently checking where your rate is at. I know we already talked about that, but they're ever changing. We want to make sure we're within our parameters, what makes sense, because time is money for everybody, but most importantly, you in finding your house, you still want to be able to get your rates where they're at and give yourself the ability to refinance in the future if you have to, before they keep rising. And most of all is just going to be location. You want to make sure your price and your location makes sense. Now, I know you could have your eyes set on one city, however, your taxes could be a lot higher there. So it's important to tailor your search around what you're looking for. And if it makes sense, it makes sense. And if not, you just have to wait for the opportunity to strike. So for me, it's just preparation, being ready to go with those three main topics. Tailor your search around that. This way you're ready when the opportunity strikes in a marketplace like this right now.
Yeah, that makes perfect sense. So we did have a question in the chat box around rates are above 6%. Actually, they're closer to 7 right now and moving up quickly. We've seen a pretty significant rise in rates over the last 4 or 5 months. So will it go down next year or keep going up? Well, that certainly is the $4 billion question, because you'd be rich if you knew. But I would tell you the experts in the industry, in the mortgage industry, are saying that they're expecting, if we see some sort of recession in the first or early second quarter, that we will see some pressure on rates to be reduced. We will see the 10-year Treasury bill go down, and that's really where the 30-year long money is derived from mortgages. So if that T-bill goes down, that 10-year T-bill starts to go down, and you see some more definition around the analytics of how mortgages are performing, we expect mortgage rates to fall at some point. We're thinking sooner than later, but in that same breath, they could go to 8%. We really don't know, but all indicators are pointing that they will come down in the relatively near future. So again, if you're buying a home based on today's affordability, if rates do come down, they're only going to get cheaper for you as that goes along. So something to keep in mind. And wow, with that indicator, we're right at our time here. So let's start with Jake today. So Jake, tell us the 3 things you would love to hear about or have our members actually remember from today's call, their takeaways from today.
Yeah. To me, it's just, first off, I say this all the time. The market does not play for us. We play for the market. So it's just knowing the scenario that you're in, knowing the marketplace you're in, and how you need to tailor what you're looking for and what you can do to fit in the parameters of the market. So, touching on that, rates, do not let rates scare you. There's always going to be opportunity in every marketplace. Rates are at 18%, or if they're at 3%, it doesn't matter. Do not let the rates scare you. Go over your numbers, have healthy communication, know where you're at, and strike when the opportunity's there. You're better off prepared than waiting, because nobody knows what can happen. And then the last, I know everybody hears this all the time. Everybody's worried about the crash. We don't know what's going to happen. There's always going to be rumors of that. And I've heard it for as long as I've been alive. There's going to be another crash. It's going to be another crash. You never know when that's going to happen. At the end of the day, you have to strike when the opportunity is right for you. You have to be ready for that marketplace, because there's no indication of when that's going to happen. And if it does happen, at the end of the day, you were prepared instead of wait. So if you can strike when the opportunity is there for you, that's what I recommend. Just being ready. And if it makes sense, it makes sense.
Yeah. When you buy a home today, I love that. When you buy a home today, it's really a 30-year commitment. You may not be in it 30 years, but you sign a 30-year commitment, and over the life of all of mortgages is 4% growth of home ownership value every year as an average. Some years more, some years less. But if you own a home over 30 years, you can expect it to grow 4% every year. So that's how you build home ownership wealth. So moving to mortgage, Tyler, tell us your 3 things you want our members to take away.
Yeah, so I think that this first one here is super relevant to the time that we're in right now, right? On average, people own a home for just about 12 years. And on the other side of things, people usually stay within their same financing, that original financing that they bought the house with, on average about 4.5 to 5 years. So if you're looking at that, people usually refinance at least once or twice in that one home that they own. On average, people usually own about 2 to 3 homes in their lifetime. So you're financing or refinancing more than you're buying homes, for sure.
Yeah.
So don't get stuck up with, hey, the interest rates aren't good, so I'm going to wait till they go down to buy a house. Because what happens if everyone has that same mindset? You get the super competitive houses are going to be super expensive now, and then you have bidding wars left and right, and it's impossible to outbid someone with cash, right? So don't be scared to, if it fits and if it works for you, don't be scared to marry that home, right? And what I like to call it is date the rate. So there's going to be opportunities for lower interest rates down in the future. So if you can ultimately afford that home with a higher interest rate, and you love that house, right? Go for it. If it makes sense in your picture, right? And not everyone, that's not going to be the answer for everyone, but if it does make sense for you, don't be afraid to execute. And then we can look at, refining down the road, because there's no competition in refinancing. You have the home now, right?
Yep.
There's no outbidding.
all
There's no
upside,
nothing
yeah.
like that. And then the second one is pretty much the first thing that we talked about was interest rate versus APR, or annual percentage rate. I like to think of it as interest rate being the price tag. So if you go to the store, you find a sweater for $50, right? You really like that sweater. But when you ring it up, it's more than $50, right? You get taxes, you get all these other things that maybe, who knows, maybe there's a sale, maybe there's not. But you're going to end up paying a little bit more than $50 for that sweater. So just think of APR as the receipt. That's what you're actually paying. And then lastly, the affordability, right? So kind of going full circle is, can I afford the house right now with the rates being where they are? And that's really kind of wrapping it up is, focus on that. I encourage everyone to focus on, can I afford this house being where I am right now financially in my job? And is this going to be a good decision? Because like Dan said, most people, if you have 4 to 5% rate of return on your house or appreciation each year, you're in it for the long haul, right? We might have a bad year here and there, but over that long haul, unless you're flipping houses, go for it.
Yeah, and I have to repeat this. I know we're short on time, but the average renter versus home buyer after 5 years of renting or 5 years of homeownership, the homeowner has 40%, 40 times the personal wealth than the renter because of that appreciation. So, and that's a verified fact. So yes, while it may seem scary to one of our listeners today, the increase in rates, I can assure you that in 1983, interest rates were over 18% in mortgages and people still bought homes. It happens. You buy less of a home. God willing, that won't happen again, but it does mean that you have to just maybe reset your expectations. There is availability in home ownership, and you buy the first one and then you buy a move-up house and then you buy another one down the road. You really have to get in at some point. So I want to thank you guys both for coming in today. It was a really interesting topic when you think about rate and cost and all of those things as it relates to buying a home. For our guest today, information about the webinar itself, the series, you can get us at info@michiganfirstmortgage.com. If you want to apply online, certainly we're always available at michiganfirst.com/mortgage. 24 hours a day, 7 days a week, 365 days a year. We're available at that 800 number. And of course, Tyler's always available. There's his information at the bottom if you want to reach out to him and learn anything more about today's webinar, or just have a question about anything, or want to start your home ownership journey. So Jake's information is on the left. If you're looking for a house, I'm sure Jake would love to talk to you about what that looks like in his market. So thank you all for joining today. And thanks, Jake and Tyler, for being our experts, and have a wonderful day and stay warm. It was snowing today. So thanks, guys. Be good.
Take care.